Hello, hello, good people. I am Benson B. Webb Jr. once again, and I am going to be your instructor for today. But why do you even need to listen to me in the first place? I'm glad you asked. So, when it comes to trading, it comes down to commodities and options. Been in the game for a little bit now since I started back in, I'll say 2018 when I got my first taste of trading. It was a gold trade I made, and I made like $700 off of it. Blew my mind that I can really take money, put it into a market, and it creates dollars for me. So, been doing it for 7 years, and throughout that journey, I was just hungry to learn more about everything when it comes to trading. So it led me into a very interesting path. So I would say that starting off, I am the founder and CEO and CIO of Golden Web Capital, a registered investment advisory firm based in Alabama, but we have offices all over. So it's a virtual thing where we talk through your financial planning, talking through investment advisory, and I can go on and on and on, but I know you came here to learn something. So along with that, I am the founder of Weston Financial Institute, which is the reason we are here today, having a way to help people understand the finances at a level that makes sense, right? I can talk to you all day, every day with these big fancy words about different sophisticated products and sophisticated investment instruments, but what good does that do you if we don't even know what the first words we're talking about? So here at Western Financial Institute, that's the goal, is to help educate everyone in understanding the why behind the buy, if you will, understanding why you're spending money on the things you are and how to grow your assets and grow that net worth. And along with that, I made sure that everything I do actually provides that value. And I want to make sure that you understand that I'm putting the rubber to the road. I'm just not just talking about it, right? My goal is to see everyone be in a better financial position. That's why it was imperative that I help found Arise Community Credit Union, the first Black-led credit union in the state of Minnesota, where our focus is helping people get back to the basics and build from there. Because I think we've gone so far out with all these sophisticated technologies and all these different things that a lot of us don't really understand how to use. So to get back to the basics of what makes sense to people, putting money into a checking account, to a savings account, and be able to grow from there. And along with that, education is key. So I am an instructor at Kaplan, helping those financial advisors become financial advisors by taking the exams to get licensed to do so. So if you think of your financial advisor, somebody that came in or somebody that's new in the industry about a year or two now, there is a good chance that they learned from me on how to become that financial advisor that's here to help you. So that's me in a nutshell. Hopefully that made sense on why we are here today, because again, the goal is to build a understanding of how we can put money back into our own pockets. Because here's the thing. When it comes to trading, comes to options, I'm sure you've probably seen things online, heard different things, been led into different seminars and everything like that. And you might think this is something similar. But I want to let you know that I'm here to fulfill the need that a lot of traders run into. So there's a challenge that I've noticed in my years of trading that is more of a consistent thing where people are walking into the industry, walking into trading, thinking that it's like a gambling or going to the casino and just pulling a lever, hoping money comes out. Well, the thing is that there's a lot of technical information, a lot of fundamental things that a lot of people aren't having conversations around. You don't really learn these things in school. These are things that you have to kind of pick up as you go along. So there's a lot of different terms that are out there, different mechanics and different tools that don't make a lot of sense if you're not prepared. Another thing that comes down to those that want to trade options but are afraid to do so, they believe that there is need for a high risk profile. So I do want to be clear. If you are not prepared to start trading options or trading in general by doing the necessary research and having someone kind of helping you through it, you're going to be setting yourself up for failure. I just want to let you all know that. I know that might be a surprise to a lot of people out there, but a lot of times we are put into position, or there's a lot of information out there that will lead you down the path that will leave you worse off than anything. So, not to sort of backtrack a little bit, make sure this makes sense, is that this does come with risk. You do not want to think that there's no risk involved. However, as we go along through this course, along through this seminar, we'll talk through how to handle and mitigate some of that risk. Because if you don't know the risks involved, It's like you're walking around blindfolded, hoping you don't run into a hole or hit a pole or something like that. So the goal here is to make sure we make sense of how we go forward because the risk is not going to change, but we have a way to fight back against it. And a lot of times people tell you, oh, you really don't need someone to tell you this. You don't really need to have no one train you on trading. You can just go on Google, you can go ChatGPT, you can go on YouTube and learn all this information. Well, that is true. You can go through the process of learning all this information, but take a step back and think about your life you have now. Do you really want to dedicate all that time, all that effort into trying to figure out the terms, right? Because there's a ton of different things out there, a ton of different strategies. And if you think each strategy intertwines with each other, you'll be running yourself into a circle. So there's a lot of information out there that can overload you if you're not prepared for it. So it made sense for this to be put in place where we can have a guide to what makes sense, right? So there's different fundamentals and building blocks that we want to talk through. And before we get in too deep about options, I just want to make sure that the terms are clear on what you're dealing with. So, number one, what are options in general? Well, what are you trading when options? What are we talking about when we say options? Well, what we're referring to is basically contracts and buying and selling contracts. So when you think of options, think of like a contract. There's only two types of contracts, right? You have your calls and your puts. Well, your call contract, and if it makes sense for you, imagine it's like a piece of paper that you're writing out a certain contract for, right? But the contract has certain stipulations and certain things that are put in place. One contract might say you have the right to do what? Right to buy, and you have the right to sell. What am I talking about? What am I buying? What am I selling? Well, we're talking about, excuse me, securities. More specifically, you have your stocks or your securities like that. Maybe you're trading currencies, maybe you're trading commodities, maybe you're trading cryptocurrencies. But just from the basics of what we're talking about here, let's think about stocks for a second, right? Think about those companies that you own or have ownership of. So basically, with your contracts or your options, you have the option to buy a certain amount of shares of a company stock at a given time before that contract expires. So when you think of, let's say, the buyer here, let's say you wanted to buy a contract or buy an options contract, well, you're putting yourself in the position to work with the seller, right? You have a buyer and you have to have a seller when it comes down to buying and selling things, right? So as a buyer, you have the right to either buy or sell whatever security or stock you want to buy or sell, and the seller is obligated to sell you those shares or buy those shares depending on what type of contract. So again, when you want to put this in a nice little bow, think about your contracts. And there are certain terms you also want to remember, or you'll see out there as you're going forward, you'll see certain things talking about your strike position. So you have three different terms you want to be familiar with. You have your in the money contracts, at the money, and out of the money contracts. So the terms here, to simplify them, just means that the options or stock or security is moving in the direction that you want them to go into. So let's take a step back and talk about, let's say for an example, you want to buy a call contract, right? If you want to buy that call contract, you might want to buy the contract because you want to see the value of stocks rise. Maybe you want to invest in XYZ company and you want to buy, let's say, 100 shares of them at one time. Well, if you buy at, say, a call contract, you can do so. And the goal here is to see the value rise, right? So let's take the strike price for an example. And when you think strike price, think of the price that you're going to pay when you use your contract, right? So your strike price is, let's say, $60. But let's say the current value of those stocks, the current market value, is, for example, let's say $70. Well, for a call contract like this is in line with what you want to see happen. So this is what we will refer to as an in the money contract because there is some level of value known as intrinsic value that applies to that contract. Meaning, if you decide to sell or exercise, term they like to use here, you'd be walking away by buying something for cheaper than what it's worth. But let's talk about the at the money contract. How do you know what that means? Well, it just means that the price that you're going to pay is equal to the strike price or the current market value. So basically, if you wanted to take an example like this, oops, that's not what I want to do. Just say the strike price here is worth $60. But let's say the current market value for this at the money contract is also at 60. It's at the money because it's right at the same price. So think of it as if you see the price equal to that strike price, you have an at the money contract. But then when you think of the term out of the money, this just means that there is no intrinsic value, or in layman's terms, there's no real value attached to this contract because maybe the contract is going against what you want to happen. So think about, let's say, a call contract. Call contract, let's say the value of that contract has fallen below, let's say, $40. So this will be known as an out of the money contract because right now the value is out of line of what you want to see happen. I want to pause here and ask, do we have any questions? I do want to also pause here just for
What's an option?
options are a contract. So when you think of options, let's take a step back. Let's use some other words that you may not have heard of before. So they call these derivatives. Why are they called derivatives? Because they derive their value from another asset. So we usually think of options attached to type of stocks or stock options, right? Because the value of the options contract is equal to that value of the stock price. But the option itself or what you're trading is going to just be contracts. And it's either going to be one or two contracts, either a call contract or a put contract. And these contracts detail what you have rights to do and obligations to do. But in essence, your options are just deriving or derivatives of your stocks. Does that make sense? Did that break
So
down
yeah,
lower?
so what else? What else? What are options traded on?
Wonderful.
Stocks, mutual funds, ETFs, commodities, currency. What are options traded on?
So when you say traded on, are you talking about the platform as if you're talking about like an option
No,
exchange?
no. What the options exist on what securities or what investments?
Wonderful question. So options can be for a variety of different securities or different investments. So got your stock options. You also have what you call yield-based options, which focus more on like debt securities. You also have index options that track a certain index or they'll trade based off a certain index. Commodities have options where you can trade certain commodities contracts. You have your currency have options, currency options. So there's a vast variety of different options that are out there because when you think about it again, you're dealing with a contract. And the contract can say that you have the right to buy or sell some type of asset in the future before it expires. Because it could be different ones. So you have cryptocurrency also has options.
Okay, thanks.
It's no problem. Thank you for the questions. Any other questions?
Not now, not yet.
All right, all right. Well, since we're talking about certain types of securities or certain types of investments you can use options for, I want to talk about something that's near and dear to my heart, commodities. So when you think of commodities, think of the things that are the building blocks of a lot of what these products are, what these companies base their value out of. So you think about it at a more macro level, or you can think of it in a micro level, but let's take macro for a second. When you think of different industries like the food industry or the energy industry, think about, or technology industry, think about these certain commodities that they would use to build out those products that you like to buy. So when people talk about different companies like your Exxon Mobil, or think of gas, right? Think of your gas company that's selling gas or oil. Well, that's traded on an exchange and is treated as a certain commodity because it has certain values that can be exchanged for different things. So when it comes to energy, those are the type of commodities that you can use to power your car, power your home, keep things heated in the house, and you know you have to pay these different things. Well, guess what? Here's a certain place in the supply chain when it comes down to these type of commodities that you can invest in and make money off of. So along with that, think of certain metals. So you might have heard gold when I mentioned gold starting off. Gold is a type of metal that is treated as a commodity. And think of those big companies that a lot of people like to invest in, like your Nvidias, right? Nvidia wouldn't be Nvidia if they did not have those gold chips that they place into those supercomputers. McDonald's wouldn't be McDonald's if it wasn't for the food a part of that. So think of agriculture. So think of corn, wheat, soybeans, coffee, cotton. Think about your favorite brands. Think about what you buy from Shein or maybe you're Ralph Lauren polo type of person. Well, those shirts cost or use cotton to create them. So companies like that are constantly or and consistently buying these types of commodities and commodities can find their value or their place in how you decide to trade them. I just want to pause here and just mention that this is kind of weird. Maybe you don't believe in this, but it feels like deja vu. I feel like we've had this conversation. I've done this before with you around because there's certain feelings I'm getting, but maybe that's a good thing. I try and derail myself through this conversation. So let me circle back and get back to it. So,
So wait, so stocks are traded on the New York Stock Exchange and on NASDAQ. So where are these options traded?
well, options are traded on a certain exchange. So you think of your Chicago Board of Options Exchange, think of the Commodities Mercantile Exchange or Chicago Mercantile Exchange. All these different exchanges are where these options are traded.
Okay.
Uh,
All right, thanks.
no problem, no problem. But why specifically commodities? Why commodities out of any other options you can trade, like your stocks, your bonds, your index funds? Well, there's something about commodities that a lot of people overlook, right? So when it comes to diversification, it can provide that because certain commodity assets are what we like to call in the industry counter cyclical. What does that even mean? Well, your business, your economy, it moves on a certain cycle, right? There are times where the market is going up or the economy is going up. Think of that as an expanding economy, getting a little bit of economics in this one. Next, you have what you call the peak, where you're at the top of the market. Then you have it to where the market takes a dip, right? And we like to call this dip a contraction. And then at the bottom, going back up when the market bottoms out, we like to call this a trough. I know I'm throwing a ton of words at you that you may not have seen before. Don't worry, we talk about them in class. So, these types of cycles, there are certain points in the market where a certain company may not do as well as other companies. So when you think of like cyclical companies that follow the cycle, think about like your cars or automotive companies or automotive industries, or think of like capital goods, right? Because think about where you are in an expanding or a peak market. There's a lot of money in this type of economy and a lot of times, when we want to spend a little bit extra money, when we have extra money, we tend to find and buy the best stuff, right? So if you think of your cars, cars tend to follow these cycles because when you have a lot of money in your pocket, you want to get the brand new spanking car it's been waiting on all year, and you have the resources to buy it. But imagine we are here in the market where we're dealing with a contraction or a trough. You can think about a car all you want to, but as long as the car you're driving can still drive, doesn't matter if you're riding on four flats, doesn't matter if your air conditioning isn't working, you're probably going to still drive that same car and avoid spending more money when the market is down. So we call that a cyclical company. But when you think of gold, for an example, gold is known more as the counter-cyclical because when the market is up or the market is down, it kind of moves in reverse. Because if you wanted to take a look at where we are now or think through how this works, people tend to run towards assets that keep their value or physical because they like that security that comes with it. So whenever the market is a little shaky or there's some fear in the market, people tend to take money out of that market or the stock market or the capital market, as we like to call them, and move into something that's more tangible. They can touch it, they can hold it, they can buy it and store it somewhere else, and it doesn't tie its value directly to the market itself. So this is one reason why gold is kind of on a tear right now. If you ever took a look at it, it's getting close back to those all-time highs that it's been creeping up on just because we've had a lot of instability. Well, maybe not instability, but economic uncertainty, right? All the tariffs going on, people losing their jobs, people getting cut from the government, a lot of uncertainty, a lot of fear that happened this year. So you can see that there's somewhat of a correlation between the rise in gold's prices and where we are now. So when you have a certain security or investment like that, it can provide some way to diversify your portfolio. And along with that, it is an inflation hedge, just like your stocks are. Because as the value of your dollars grow with the investment you're investing in, it can fight against inflation. Because if you want to think of the stock market, I know I keep bouncing back to the stock market, but everyone's familiar with that. They say that on average, you can see a, let's say, 10% return on your investments. Well, if you take into account inflation and how inflation starts to eat away at your value of your dollars, let's say inflation is around 3%. Well, if we wanted to take a look at the dollars you invested, if you invest in the commodities or the stock market like this, your dollars are gaining value, gaining profit, or gaining capital, or appreciating rather, but your inflation takes away from that. So if you think of the difference between the money you returned and the dollars that lose their value, you're still walking away with a 7% investment return. So it's adjusted for inflation. So commodities move the same way because gold is seen as that stable value that can keep growing as time goes on. And it's not just a market that is specific to America. The commodities market is a global market. It's all over the world because you have different companies, or excuse me, different countries, different markets, emerging markets, the global economy that base their value or what they're creating off of the commodities that they have access to. And then when it comes down to the opportunities you have, here you have a way to leverage or use other people's money in a way to grow your own accounts. While this is something you want to keep in mind that is still going to add on that risk, it gives you a way to grow your portfolio, grow your trading balance in a way that, if done correctly, can continue to grow. Not to say that there's no risk involved, right? Not to say that there's a chance you won't lose money. There's a great chance you might lose money, if you, especially if you're investing in something you're not familiar with. But this is where that risk strategy or risk management comes into play. And honestly and truly, when it comes down to the market itself, you can see a ton of different strategies out there. You can think of a ton of different indicators, different philosophies on how to trade, when to trade, and what to trade. But when it comes down to it, it all comes down to managing your risk. Because if you do not put more money than you feel comfortable losing, you will never lose that much money. So, with that being stated, if you don't want to lose $1,000 in the market, well, there's a great chance if you do not put $1,000 into the market, you won't lose it. That's something that a lot of people do not, it's funny, but a lot of people don't realize how dangerous this is because they get certain feelings when they
You
trade.
can't afford to lose it. You can't afford to play.
And that's the reality of it. You cannot do so, but there's so many people out there. You just look online now that's telling you, oh, if you put in $1,000, you'll make $20,000 tomorrow. You
Hey, I'm sorry to interrupt you here. Can you go back one chart?
okay,
Go back one more. Go back one more. You got to add premium on here,
okay. Good idea. Premium.
and now you're explaining why. But you got to add the way, when you buy stocks, as you know, you put $1,000, and if the stock is $10, you get 100 shares. But with options, you put up a premium amount, the
Mhm.
option premium, to control a large number of shares for a period of time. And then if it expires, it can expire worthless. So you could lose. I know I'm preaching to the minister here, Benson, but I think that's a point you have to put up as option basics.
Okay. Gotcha, gotcha.
You know,
And I didn't put like long or short in here either, so I need to put that in here as well.
but yeah, but that's the idea. So, when you buy options, you're renting the stock for a period of time, or the right to buy or sell the stock for a period of time and you could lose it all. You could lose if it expires worthless, you lost it. But you can't lose more than that, as you know.
Absolutely, absolutely.
So upside gain with limited risk.
So yeah,
And
I'm
then,
gonna
all-
make
and then
a
yeah,
slide just for that.
what's that?
I'm gonna make a slide just for like the long calls, long puts, short calls, and short puts, just so we have that.
Yeah.
And I have a yeah, I like that. Yeah, thank you for bringing that up.
Well, okay. So now you can go back to now we return you to your regularly scheduled program.
Absolutely, absolutely. So in essence here, you cannot lose more than you put in with certain types of options. So how do you put yourself in the best position to win? Well, you got to know your numbers. You have to understand how much you're trying to make and how much you're willing to risk per trade. And it does require you to understand what position you want to trade with. How much do you feel like losing? And when you think of a risk strategy, just to put it into perspective, how managing a risk can be beneficial. So let's say you have a strategy that you found that produces a 60% return or wins 60% of the time, right? Let's say 60% of the time you win, 40% of the time you lose. And you do, let's say, 10 trades just to test this out. And 10, and for an example here, let's say you're trying to trade $1,000. Well, to make sure you're putting yourself in the best position, you want to know exactly how much you're risking for the reward you're trying to get to, or the reward to risk ratio, risk to reward ratio, as we like to call it. And let's say for every 1% that you risk, your goal is to make 2.5% for return. Why is that important? Well, what's 1% of $1,000, what you're putting in there? Well, you're going to put in $10. For every $10 you're going to risk. You have a chance to make $25. I'll make sure I clean this up a little bit more. But the goal here is just to show that, let's say you win 6 times out of the time. So first time you win, second time you win, third time you took a loss. Let's say you had a string of losses, but you came back and finished strong. Well, you multiply the number of times you lost 4 times. So you lost $40, right? That's a loss you took. However, you won 6 other times, and your return for every time you win is going to be $25. So you multiply 25 by 6. You're looking at what? $150 that you made. Well, you deduct what you lost from what you made, you walked away with $110. But let's go a little further. Let's say you're not that good. Let's say you somehow, some way, only were able to make back 50%. You win half the time and you lose half the time. Well, you lost one more than you gained. So now you lost $50. And guess what? That reduces how much you won up here. You only won 125 because you only won 5 times. Well, guess what? You do the math on this, you still walked away with $75. I'll even go a little bit further. Let's say you lose more than you win. Let's say you only win 40% of the time. Same thing here. Well, now your losses have grown to $60. And your wins, well, they drop down a bit down to 100. Guess what happens if you subtract 60 from $100? You're walking away with a $40 profit if you win 40% of the time on average. You lose more times than you win, but however, you're walking away with some type of profit. People have a hard time getting here because after they see the string of losses right here, they either over leverage, revenge trade, or give up because they think, oh, I'm a loser. Now we're getting to the psychology of this. This math is always going to be there, but the real goal to manage your risk and to win in this type of industry is understanding how to control yourself from spending more or risking more than you need to risk. Here you can have a sustainable way of growing. $40 isn't like oh, I'm going to go to the casino and show everybody the big winnings I've made, right? But the goal is to stay in the market to where these wins compound over time. And as time continues to move, these $40 you're making here can continue to grow. Let's do this next week. Let's say you have 10 trades a week. Maybe that's a little bit of excessive there, but just give you an idea that if you can manage what you spend or what you risk, you can manage how much or how long you stay in the market. Because the way you want to think about it is, if I'm going to go fishing, I'm a fisherman. What sense does it make for me to go out into the ocean, throw all my bait into the water, and hope I get a big catch? Right? That's what a lot of people do when it comes to trading. They go out into the market, they dump all their money in the market, hoping that because of the probability that the money can come back, or the possibility that they can triple their money, double their money, quadruple their money, that's such a great pool that they end up spending all their money and losing everything if it doesn't work out the first time they throw all their fish or out their bait out there. So the goal is to make sure that you can continue to build a life off this, build these equities up, or build your equity up in a way that can be sustainable. Because at the end of the day, this only can work if you're sustaining yourself. So what do we need to do? How can we be of service? Hopefully this made sense, but the goal here, so let me backtrack. I think Oh, nope. Let me continue going, make the sale, make the pitch. So, hopefully, this is something that was beneficial for you. You grew something from this. And if you want to continue to learn more, we have some options to help you on your journey. If you're the type that just wants to continue to learn as you go on weekly basis, we have something for you. We offer classes, private classes, every Thursday for $27 a class, giving you a chance to have these conversations and ask questions and learn as you want. But maybe you're ready to take it a step further and ready to get serious about your trading and want someone to help you navigate the behavioral side of things. Well, we offer that as well for $250 a month. You can have one-on-one weekly strategy sessions with me to help build out that plan. But
Wow.
maybe you're at a point where you've already got a lot of things established and you just want to know what's the best investment to make. Well, that's also something we offer here. Maybe you just want to
So let me ask you, can I ask you a couple questions here?
Absolutely.
All right. So let's say I take your class and I start to understand options, whether it's commodities or stock ones or whatever,
Mhm.
and I decide that I want to start investing or trading. How much do I need to get started?
Honestly, you can get started with $0. We can get started with a paper trading account because we want to
Ah,
build up the skills because that's the first problem people run into if they really don't build the skills up. They just hope and pray and
okay. So
gamble.
how do I do it? So are you able to help me set up a paper trading account, and that's what we use to teach on?
Absolutely. Absolutely. I can. We have a few different options out there. I'm a fan of Thinkorswim.
Yeah.
Maybe you're interactive broker before you like interactive brokers platform, which is all good. But if I had to recommend anything, you wanted me to help set it up with you. Thinkorswim through Charles Schwab is a great place to get your feet wet in a sense to
Okay,
learn.
so I could start with zero money and just learn from you and trade and see how it works out without putting up any money.
Absolutely.
All right, so now when I decide that you trained me enough and I'm ready to invest, then how much money do I need in order to start investing for real?
Well, I would say you want to get to a point about having around $10,000 to really see something because if you want to keep the same strategy you had before, you want to get 2.5% or risk that, that's what, $250. Now you're dealing with something. Now if you make that only weekly basis, or let's say you do it a week, that's $1,000 you're making. So the goal here is to have enough capital to where it makes sense to do so. But until then, you want to make sure those dollars are putting towards something that can provide a better return. You may not feel comfortable doing so right now. So the goal here is to get you comfortable at that point to see how much you can make off of it. Because maybe you don't need $10,000. Maybe you only need 1,000 and you can make this happen. It all depends
I
on
can open an account and start trading with just 1,000. I wouldn't start it right away, but if I had the weekly sessions for 4 months and then we got smart or comfortable, you're saying that with just $1,000 or $2,000, I can start trading?
exactly.
Okay, that's good to know.
Alrighty. So this is one of those sessions that still is based off this free plan. So this is going to close out in like a few minutes or like a minute now.
Well, I guess that means our time